Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of Orats. Orats is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to look at volatility skew and learn how it can be used to help find an options trade. We'll also go over our recent trades from the previous weeks. Matt, if you're ready, do you want to share your screen and go over our positions?
Sure. My son said whenever I wear this sweatshirt, it reminds him of someone from the future. So we'll start off with, hopefully, if we were in the future, we would know what trades to make. So we'll start off with our historic trades, and then we'll come up with another trade. We've been doing pretty well here with our picks over the many weeks that we've been here. So yeah, let's check it out. All right, so go into the dashboard here. We have an old EWJ put spread. It looks like it's up a little bit. Also, I could see that there's some negative edge there, so probably not as good. That's what that means. For example, this 7 cents here has negative 20% of edge, so that's probably not, our long is probably not worth that much. So with our smoothing theoretical value, so it shows us up, but we're probably right around break even, which is all right. And then we did an MCHI, the Chinese ETF last time. That's actually fairly valued. We sold it for 58 cents, and now it's 47 cents. So we're doing well on that one. As we saw on that one, the implied volatility was much lower than the. So we'll just take a check of this. So it's nice from the positions you can see all this, but look at how much different the historical volatility is from the implied. It's just kind of in this grinding up mode here. So we have till here for the break even. So even if it continues this uptrend, we'll be pretty good. Maybe think about getting out of it at some point if the uptrend continues.
That channel looks like that upward channel of that trend line looks interesting.
Yeah. So, again, but then you have a little bit of a resistance channel. So if it, so it looks like there's a battle right now. So it could go down, could go up. But it looks, if I were betting, it looks like the upward channel is a little bit stronger. So we'll see how the Chinese ETF does. And then, like I said, we're already up, and the vol's so low, it's just getting crushed on this uptrend. So, all right. So that's those are the trades that we have. Sometimes I like to look at, our trade journal. Again, we've been teasing out. We're going to release it in earnest pretty soon, but I could go back to, just to see. Our last show is at this time on April 1st, so that's so I could see what the trade that we did, and so indeed that was the 58 cent short call spread. So it's kind of nice to be able to see these in this type of a table. All right. So any questions on that, Tyler, or should we go on, or what do you think?
Yeah, trade's going well so far. So this week we're going to look at implied volatility skew, and there's a few ways to look at that in the dashboard. There's the chain. We have some indicators in the stock scanner, and then it's a little bit in the outlook as well. So I'm sure you'll go over all those.
Yeah, but in order to I want to find a good stock or good symbol to trade on. So, I have some skew cheap indicators in here right now. So I want the stock price minimum of 25. I want confidence. That's our confidence between 0 and 100. Volatility between 5 and 30. How wide the market is. Our slope percentile. My office mate wants to come in. So here she comes. She usually helps me on these, so that's why I need her. And so, but the slope forecast, I want that to be a minimum of 1. So we're looking for something that's forecasted higher, and that's what I'm. And then the slope percentile. So that's what I'm sorting on. And so if you look at slope percentiles, I don't really want to trade at oil or silver, but XLU looks interesting. That slope is the percentile. Let's take a look at it.
Can we go over real quick, just for the newer viewers, sort of what slope means, what the percentile means, sort of how it relates to the skew and how to trade it?
Yeah, good question. So I think the way to look at that, here, I'll click on XLU and we'll go over to the option chain. So so slope is, let me see if I could get a drawing tool here. So slope is, how steep this skew is, or this skew right here. So what happens is the puts are on the left and the calls are on the right, and those change. Like sometimes this goes down, sometimes it goes up. So right now, and we have a measurement of slope here for each month, and so usually slope for XLU and the bigger ETFs is in the 3 and 4s, and right now it's 1. So that means that the line is flat. The steeper the line, the higher the slope. So usually it's steeper. So you can see how this one over here is steeper, and that's a 3% for September. Then let's just say then this one in April, that's a 0.9, so less than 1 versus 3. So that's that's the lower strikes over here. So the lower strikes implied volatility, which we just say the puts, the out of the money puts are much higher than the out of the money calls for this one, but for this one they're more equal.
Okay,
that makes sense.
Yeah. So right now we're seeing sort of a left skew, I guess you'd call it. How does, like, I see sometimes, people saying that there's like a smile, or this is less exaggerated. Is there a difference between the two?
Usually, so the smile component, so the curvature in it is another measurement, which we term as derivative. So that's the derivative of the tangent. So we usually just look at the tangent, especially for stocks like this without that many strikes. If there are more strikes, you can start to look at the curvature. But on the very left-hand side, it's dramatic. But usually you're trading right in kind of the meat of it there, and then so it's more of a straight line kind of through here that we'll be looking at. And what we think is that this, XLU is quite flat compared to its percentile over the year, and compared to some moving averages. So we're going to be a buyer, and what that means is we're going to be buying up here, and then we're going to be selling over here. Or, so what we think is going to happen is the slope is going to go up. So these strikes are going to go up versus these strikes kind of coming down. So we'll put on a skew that looks for that. And then what we'll do too, Tyler, is so if you put on a trade like that, you get a lot of delta, so you don't really want a delta. So a skew trade would be like a short put spread. So that a short put spread would be selling a put and then buying an out of the money put, right? So the problem with that is you're selling a lot of vega in that type of a trade. And so first we want to look at how we feel about volatility itself. Oops. So XLU, I'm smacking my mic here. So XLU is not like MCHI. It's pretty much fairly valued. So I don't want to be selling a lot of vol. So the trade that I'm thinking about for this is kind of buying an out of the money and selling a near money that is closer to the money, and buying it out of the money that's farther away from the money. Hopefully that makes sense. So what we're trying to do is sell something close to the money, buying skew by buying something that's out on the wings, and we expect the wings to go up. Hopefully that makes sense. It's a little bit, this is a little bit more complex of a trading strategy, but again, I think that for people looking for their niche and the way they trade, if you start to understand skew, and especially the way that Orats measures it, it's definitely a place that you could get some edge, I believe. So, to recap, we've looked in the stock scanner for symbols that have where we forecast the skew to go up versus where it is now, and the slope percentile is low. So this is only in the I believe it's the single digits per percentile. The third one down, yeah, it's about 2.78. So that's very low. That goes between 0 and 100 percentile. And so we think that the XLU skew, and another thing that we could do is look in the trade builder and go graph skew. So we could type slope. Our slope is there. Let's see if that comes up. So you can see how low that is. That's 1 year. So let's look at 2 years even. So over 2 years, you can see how that slope is very low. You see that, Tyler?
Yeah, interesting. That's where that percentile is coming from, that very low percentile.
Exactly. So given that, now we have an axe to grind, so to speak. So now we'll put together a scan. So I don't want to sell a put spread. I'd rather do a diagonal, which would give us a longer dated long put versus a shorter dated short put that's nearer to the money. Hopefully that makes sense. I'll show how it comes up. But I chose long put calendar, and whereas a put calendar usually has zeros as the strike width. So in a calendar you're usually buying and selling the same strike. What I'm saying is the long put strike minus, we always go the leg 1 minus leg 2. So leg 1 is the leg 1 is the long put. So that would be farther out of the money. So that's a lower strike. So that would be lower strike minus a higher strike is going to be negative. So we're able to set the strike width here. So we want that to be negative. Realize that was a little complicated, but we're able to set the diagonal widths here. You could also just set it negative 99 and positive 99, but I wanted to limit it here. So it gives you a lot more control. So you could see down here, our minimums are 2 and a max. You can't see the maximum, so it's just getting over the 2. So these are the put calendars that are coming up based on all our rules above, meaning days to expiration. They meet all those criteria. Delta. So the long put is going to be farther out of the money as the short put is. As a matter of fact, what I'll do, I could even go farther. I could go 10 delta and then make this like 25 or 20 and then make this 40. So we're still buying like a 40, make that minimum 25 or something like that. So the short, we want to be closer to the money. The long, we want out of the money. And then we rank these. I like to rank based on forecasts a little bit more than distribution edge. And we've talked about those in other videos. For the smooth edge, again, I want to be around 0. I don't want to be, so -2 to 2. So that really narrows down the field here. So, those are smooth edges. You want those more to be near the theoretical value. And that will ensure that you'll get a fill. If it's too wide and you're seeing a high smooth edge, you're probably, the market makers are looking at that type of a smooth edge. Orats, it's a really good smooth edge. And that was, we'll look at it a little bit later. hopefully remind me that orange line in the option chain is the smooth. So you could see, the stock is 65. We're selling at 65 and buying at 63. It's only two. Let's just take a look at what this looks like. So, so it's 13 cents. 70. We're buying 75 days, selling 20 days. 63 is the long strike. 65 is a short strike. So so we still could lose that. Like if it goes to zero, we're short the 65, 63 essentially. So we could lose that difference, $200. And we're paying, but most likely so here's the payoff picture. So the payoff picture, this is what I say, you could lose, if it goes to zero, if the stock goes way down, you could lose $200. That's the difference in the strikes. And plus the amount that you paid. And then mostly you're going to be making money, over most of the stock range. That's why there's like a 78% probability of profit on this one. And this really doesn't take into account what we're really trading on is the implied volatility of the 63 going up more than the implied volatility of the 65. So I think we have two things working in our favor in this particular stock. Does that make sense, Tyler?
It does. So you chose to do a long put diagonal. We've talked about skew in previous shows a little bit, and we traded mainly like the risk reversals and the callers. Is the long put diagonal just another kind of trade to have in your tool belt when you're trading these kind of skews?
Yeah, if you do a risk reversal, that's a lot of deltas. You're taking a big axe to grind on the deltas. Same, even with a collar, you have a lot of long delta there. So if you want to have, so I didn't want to have much delta, and I didn't want to have much vega, meaning I didn't want to sell vol. I'll be long a little bit of vega in a calendar, because it's some people say there's not even that much in a calendar, but it shows vega in a calendar. But mostly what you're getting is either decay in the front month versus the back month, or in our case, we hope what we're betting on is that the skew will come up eventually in this and get more in our favor, and that will lead to some profit.
Okay, so in other words, we're trying to this is just a better way of isolating that movement in the skew that we're sort of forecasting.
Yeah, if we had everything, we'd have flat deltas, flat gamma, flat theta, flat vega, and just had on a position that would benefit from the skew. But again, the two that you mentioned in a short put spread all have Greeks that we don't really want. So this is the best Greek profile. In addition, I want to have as many things working in our favor as possible. So that's why we looked at volatility at first. It looked kind of fairly valued. So, I don't want to be short volatility, and I don't want to be long or short deltas in this. So, this is a little bit long, but again, we're a little bit long vega down here. So as the stock goes down, the vega will come up. So this is pretty, I like this trade for those reasons. It flat Greeks and benefits from what we think we're going to benefit from.
That makes sense.
All right, should we put this on?
Yeah, let's do it.
All right. So we'll add some alerts. Actually, it looks like another. Let's do this. Another good trade came on, and this price went up. So let's get out of here while we were talking. But here's another good one. You're only paying 11 cents, 64.5. Similar payoff picture and similar everything else. So let's. It's 14 cents of edge, so we're probably going to have to pay more than that. We'll pay it. We'll pay the offer on this one, and then so we'll force that, and we'll add some alerts here. Profit at we wouldn't profit until we got to about 300% profit here, and then I'll just add the note, paper in the Trader Hub. T-hub. And then so if that hits and the market's not wider than that, we'll hear about it by text message or email. So that's the trade. So what I'd like to do now, I promise you, we talk about let's see, go back to the scanner, and look at, since we traded it, it went off the top here. So we could look at this other one. It's closer related: buying June, selling April. So what we could do now is kind of look at the structure of this trade. So I could go to the option chain, and the option chain, takes you down to, so you can see where you're selling this one and you're buying this particular one. So that looks fine. But what I like to do is I like to see in the month. So we're buying skew here. So we're buying something that's a little bit higher up the chain, and we're selling something a little bit lower down the chain. So that's the skew that we're buying. We are, of course, buying a little bit of vega there, but not so much, because there's more vega as you get closer to the money. So we're a little bit far out of the money here. So what we're hoping to see is this skew to steepen, and then that's really all we want, and then we will make money on the skew steepening, and then we'll also make money if the stock sticks around here. So that's why I like to trade, Tyler, and the diagonal I like as well, because you lose if it goes down, but you also make money if it goes down, because you're going to be long vega. So I like this trade for the reasons that we've been talking about.
Gotcha. Yeah, it's really interesting to see those highlighted on the graph there, and you visually see sort of why we're trading this strategy.
Oh, I forgot to expand upon the smooth is this orange line. So if you get something way off this orange line, the market maker knows about it. It's probably a really wide market or something. So you're not going to be able to trade those, even though you might say, oh, let's trade that. The market makers, unless there's a resting order there that someone has in there, in which case the market maker would usually trade it. I used to be a market maker, so I know this. So you're not going to be able to trade that. So the market makers will fill you right around the orange line, usually what happens here.
Got it. There is some things I wanted to add to the sort of explanation of the slope measurement.
Okay.
See online a lot, like people, drawing that smile or saying that it's, a smirk or left leaning or right leaning. The slope itself is just a measurement, and we see sort of stocks all over the board. Like we see stocks with a really curved slope, really flat slope, left or right leaning, or left or right skew. It doesn't mean much on its own, other than it's just sort of an indicator of where the calls are relative to the puts. But when the power that Orats brings to the skew measurement is we draw a forecast, and that's what we're using here. So we're comparing the slope to the forecast of slope, because we draw our own volatility surface, and then we compare it to the forecast, and we're also comparing it to its history. So that's sort of where you can derive a lot of meaning from the slope measurement.
Yeah. So our forecast is this green line, and where it is right now is a red. So we would think that this is going to come up, and this will go down relative, and that will benefit this more out of the money, higher on the skew, and then this one will be won't be as affected by just a change. It's kind of like an axle. So, or a teeter-totter, and if you're closer to the middle of the teeter-totter, you're not going to move that much, but if you're on the outside of the teeter-totter, you're going to move a lot. So a little bit of playground humor there for you, Tyler.
I like that analogy. I mean, it makes sense. The further out of the money you are, the more sensitive you are to that movement.
And this market has gotten complacent. Vol's way down, implied today, stocks up a bit, and as things start to happen and shake up, vol should come up, skew should steepen. That's going to really help us out. And then we have time too. So if nothing happens, we have 19 days of theta that's coming our way. This is a good day to trade.
All right. I think that's it for this show, Matt, unless you want to add anything else.
Yeah, no, I think it's this was a more complex show, but again, I think traders really need to find their niche and trade things that they understand and really could research, and giving them their own competitive advantage out there. And I think using slope it's a little bit hard to understand, but if you dig in and you learn it and use Orats, like we have, we've been using this since the 90s to trade. So, it's a good way to gain a competitive edge out there. And, you could do the things that we talked about. It's really hard. I mean, imagine how much data goes into this. You have to like summarize all of these dots into skews, and then you need to feed them into a stock scanner, find them, and it goes, you compare them to 6,000 other stocks, and we're updating it all real time. So there's a lot of competitive advantage once you learn about skew, and use Orats to find these and then understand which trades do well. And we also have backtest that will show you, like in shallow skews, which backtests do the best. Those are the environments. So I mean, those are another thing that you could use, and I think we've talked about that before, but we could always talk about that again too, Tyler, about measuring the environments and how well backtests do, and because once you know that you think this is XLU is a good buy for skew, then you say, okay, what's a good strategy to use, and that's where the backtester could help. So maybe we'll do another show on that.
Yeah, that sounds good. Yeah, and we talk about skew and slope a lot on Orats University as well. So there's a lot of resources on our website that you can use to learn more about skew and how to trade it.
Right.
All right. Well, if you guys have any questions, you can leave a comment on the videos. We always read those, or you can email us at support@orats.com. Thank you, Trader, again for hosting us, and we'll see you next week.
Thanks.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.